Oil prices seem to be on the rise over the past week, yet oil bulls seem to be taking a break over the past 24 hours. Hence today in the report we are to have a look at the data relating to the US oil market, the Fed's interest rate decision and a wider look at the outlook of the demand side of the international oil market. To conclude with the report, we will also be providing a technical analysis of WTI's daily chart. Making a start with the US oil market, we note that on Friday, Baker Hughes reported a lower number of active oil rigs in the US economy. Characteristically, the number of active oil rigs dropped from 496 to 492, which is the second weekly drop in a sign of low demand in the US oil market. Yet on Tuesday, we note that AP reported a drop of minus 2.4 million barrels of US oil inventories, implying that the demand side in the US oil market surpassed oil production levels. On the flip side, EIA reported a widening of the increase of the US oil inventories the following day, highlighting the possibility of a slack in the US oil market and thus muddying the waters. Please note that the release of EIA crude oil inventories figure had a marked negative effect on WTI's price, implying that oil traders are keeping a close eye on US oil market data releases. We expect that should in the coming weeks signals of a tightening US oil market emerge, they could provide some support for oil prices. Yet not only directly oil-related data tended to affect oil prices yesterday, we also had an unexpected easing of the US CPI rates for May, having a bullish effect on oil prices in the early American session. Characteristically, headline inflation remained unchanged in May, as on a month-to-month basis the headline CPI rates remained at 0% month-to-month. The release tended to intensify the market's expectations for the Fed to ease its hawkish stance, which in turn could have a positive effect on economic activity for the US manufacturing sector and on the demand side of the oil market. Yet, the Fed sent out some mixed signals, as on the one hand, the new dot plot showed the readiness of Fed policymakers to keep rates high for longer. Yet on the flip side, the bank seems to remain largely data dependent, and a possible wider deceleration of the CPI rates in the coming months could allow for an easing of the Fed's monetary policy. Should we see Fed policymakers in the coming week actually suggesting that releases are to remain high for longer, we may see the statements having a bearish effect on oil prices, as they could imply indirectly an easing of the demand side of the US oil market. Also, we note the release of OPEC's monthly oil market report. In its report, OPEC seems to be sticking to its forecast for a relatively strong oil demand in the coming months. It should be noted that the forecasts remain optimistic despite a lower than expected consumption in the first quarter of the year. The organization expects world oil demand to increase by 2.25 million barrels per day in the current year and by 1.85 million barrels per day in the coming year. It should be noted that the forecasts derive from OPEC's last month's expectations and landed in the current report unchanged. The optimistic oil demand expectations tend to support oil prices. On the flip side, we also note that the International Energy Agency in its monthly oil report tends to be less optimistic, expecting a drop of oil demand. The report tends to blur the picture of the international oil market and hence may be weighing on oil prices. In addition to IEA's monthly oil report, we also note reports that Saudi oil exports towards China seem to have been reduced, which may hold oil bulls somewhat. Also, uncertainty in the areas on the rise, as Houthis on Wednesday took responsibility for an attack by small crafts and missiles on a Greek-owned coal carrier. An intensification of uncertainty tends to support oil prices as the supply of the commodity gets under threat. On the flip side, a possible agreement between Hamas and Israel, or at least an easing of the tensions for the issue, could weaken oil prices. WTI's price seems to have stabilized just above the 76.7 support line, and a sideways motion seems to be prevailing in the past 2 days. We also note that the RSI indicator runs along the reading of 50, implying a rather indecisive market about the direction of the commodity's price. Hence, one could argue for a continuance of the sideways motion. Such a prevailing of the sideways motion would imply an interruption of the upward motion, yet at the same time respect the 76.7 support line as well as the 80.25 resistance line. Yet, for such a sideways motion to prevail, the commodity's price action would have to break the upward trend line guiding WTI's price action over the past 6 weeks. As long as the upward trend line remains intact, the bullish outlook for the commodity's price seems to remain present. Should the bulls maintain control over the commodity's price direction, we may see it breaking the 80.25 resistance line and thus pave the way for the 84.25 resistance barrier. Yet we note that WTI's price action peaked yesterday and started to drop, a tendency that continued during today's Asian session. Yet for a bearish outlook, we would require WTI's price action to initially break the pre-mentioned upward trend line in a first signal that the upward movement has been interrupted, and continue also to break the 76.7 support line and take aim of the 72.85 support level. We hope that you found this report useful. From all of us here at RNFX, best wishes for solid trading.